There's $35 trillion in retirement accounts in the US. There's like no more money anywhere, period. And the nice thing about it, it's all people you know that have it. It's like your friends and family. It's the people, the guy you're running with, or, the person you do yoga with. I don't know. Like they have an IRA or 401k. It's everywhere.
Are you ready to take the next step in your multifamily investing career? The time has never been better than now. Think Multifamily's Deal Analysis Workshop is a comprehensive live training course that will help increase your skills, knowledge, confidence as an investor before you invest. This workshop is a unique experience that provides hands-on instruction and guidance directly from Mark Kenney, who has completed over 100 multifamily syndications valued at over $1 billion. This course goes beyond theory, as you will be presented with real case studies and practice scenarios to work out in class. By the end of the training, you will have significantly improved your ability to evaluate deals quickly, make informed decisions, and take your investing skills to the next level with confidence. For more information and to register for Think Multifamily's Deal Analysis Workshop, go to thinkmultifamily.com/DAW. Use code Whitney100 to save $100. The Deal Analysis Workshop is designed for both beginner and experienced investors. Whether you are looking for a foundational understanding of how to analyze multifamily investments or looking for fresh insight on how to pivot your analysis method for this current market cycle, this is a workshop you have been looking for. Register today at thinkmultifamily.com/DAW. Use code Whitney100 to save $100.
Welcome back to the Real Estate Syndication Show with the world famous Whitney Sewell. Hey, wait a second. As I always say, this is not Whitney. It's his buddy, Josh McCallan. It's an honor to guest host for my friend, who's also a hero of mine with all the work he does with the Omna Foundation and Life Bridge Capital. We're big fans of Whitney Sewell. And we're honored to be part of your community. I mean, the real estate syndication community is one of the best on the world of education and podcasting. Why? Because it attracts both groups, right? It attracts those of us who are professional syndicators like myself and Whitney, and it attracts those of us who have discovered the power of direct investing through syndication. So welcome to the community. Hey, today's a surprise juggernaut show. It's an honor. It's an old friend of mine, Mat Sorensen. He's written the book on self-directed IRA, SDIRA. You've heard this term. But if no matter which side of the equation, whether you run projects or whether you invest privately in projects, there's a surprise, maybe 3 surprises in this episode. And I'm going to tease them right now. 1, he's going to reveal to you that if you raise capital, that there is no more sure way to do it than through the self-directed IRA vehicle, because your friends, your family, even your colleagues all own one of these. They all own an IRA. They didn't even know you could invest through that IRA into the projects you're doing, which are way better. The syndication projects that are in Main Street America are way better performing, way better collateralized for the most part than Wall Street. Wall Street typically isn't as well collateralized as our syndication projects like you do and I do. So 1, he's going to reveal that. And guess what the number is? Yes, I'll tease it and I'll say it. $35 trillion with a T, trillion dollars sitting there. The largest aggregation of capital in the world is in American IRAs. And you can unlock it with groups like what we're about to describe. And he's going to share the confusion about this industry. He and I go into it. Well, what happens if this? What about that? What's UDFI? Is there a penalty for using my money this way? Because I'm not 60 or 70 years old. The answer to all of that is you got to wait to find out in this show, because he's going to explain that. He's going to answer the FAQs. And he talks about opportunity in 2023 and beyond. Wait till you hear how he breaks down the economy. So even if you're just listening to the show because you love great content, hilarious conversation, and wisdom from these guests and hosts, then you're going to find out about how there's trouble in them brewing. There's trouble brewing, as you may have heard, but he's going to talk about how trouble, as he sees it from investing for all these years, is opportunity. And he's going to show how the IRAs and the world of the IRAs probably are one of the main solutions to that trouble. I look forward to you letting me know in the comments and in the reviews whether or not this was a show of value. Please mention it. Whitney and I joke, we're always trying to grab more reviews, and especially if you could mention one of the shows, we'd be very honored. This is Josh McCallan from Capital Hacking, which is our show, and Accountable Equity. You're going to love this episode with Mat Sorensen. It is an absolute honor to have you here, Matt. Welcome to the big show with Whitney Sewell's Real Estate Syndication Show.
Thanks so much. It's an honor to be on. I remember talking to Whitney like a year or two ago. It's like every day almost. So I'm like, what? I do 2 podcasts, 2 shows a week. So I know what that takes. And I feel like a whip.
Well, Whitney is a hero of mine. As a matter of fact, my name's Josh McCown. For those of you who have not met me, I love Whitney. I donate to his foundation for children, and he invests with us as well. I've been honored to be one of his top guest co-hosts, host. Anyway, what we're going to do today for you folks is we have, through the ether, flown in a true expert in the world of self-directed IRA. And he's going to not only unravel these kind of secrets that most of the world doesn't realize about self-directed IRA, but we're also going to do a whole big FAQ. So buckle up. Let's get to it. Matt, would you share a little more about yourself for the listeners who have not yet met you as I have?
Yeah. So Mat Sorensen, I'm an attorney, have a law firm called KQS Lawyers, but most of my time is actually at our company called Directed IRA. We're a self-directed IRA trust company, regulated, audited, all that, have over $1 billion in assets, 12,000 accounts, growing quickly. But I've kind of been the self-directed IRA guy, for lack of another label. I wrote the book on self-directed IRAs, the Self-Directed IRA Handbook. It's the #1 book in the field. All my competitors use it to train their employees. The association in the field uses it for certification training. So I kind of just focus in that as an attorney and then started offering accounts and helping clients do it. So we're all about people taking their IRA or 401k dollars to invest in what they want, which real estate happens to be one of the most popular things people actually want to invest their money in.
Well, and I've been around this world for a while. We've had some of your members join our group. So what I want to tell you is, if you don't mind, we're going to jump in to a few of the questions we hear a lot. And this show obviously caters to 2 great groups: the people who actually run syndications. So this is important. Yeah. They need to know what you know. And then those who are using this show to find out why people choose syndications as an investment strategy. So both groups are going to love this. We need to define terms because not everybody has listened to this show before, and we want to catch everybody up. No listener left behind. This is your driving university. So what is a self-directed IRA, and why is there confusion about that terminology? What's different with what you do?
So basically, a self-directed IRA is an IRA that can invest in any asset allowed by law. And the law only restricts art, collectibles, and S corporation stock. So IRAs have always been able to own real estate. The problem's been most people have an IRA at Fidelity or TD Ameritrade, and they're broker dealers. Well, what do they let your IRA buy? What they sell. So you can't walk into Taco Bell and get a Big Mac. You're going to get whatever's on the Taco Bell menu. It's the same thing at TD Ameritrade or Fidelity. So, but there's about 30 other companies like ours that'll let your IRA invest in real estate or a private fund or a startup or crypto or any alternative asset you want that's allowed by law. So really what you do is you're like, okay, I want to invest in a real estate fund, or I want to buy real estate myself, or do a private money loan with my IRA or 401k funds. You don't call Fidelity and say, hey, I want to invest in this private fund or this piece of property down the street. They're going to say you can't do it. Not because IRAs can't do it, but because Fidelity IRAs can't do it. So you just got to transfer the account, which is no tax or penalty, over to a self-directed company like ours, Directed IRA. And then you're here and you're like, all right, I want to invest in this fund. Here's a subscription documents. IRA is going to own it. It's putting in X amount of dollars and getting these units. We send the money to the fund sponsor. Then your IRA owns it. It gets the profit. When the property sells or the fund closes out, it gets all the proceeds back, any cash flow, of course, coming in. So that's basically how it works, and kind of called a self-directed IRA. But it basically just means you can invest in what you want to.
Yeah. And I remember when this was first introduced to me, it was about 5 years ago. And I'm in my late 40s now, just never really picked up on this. And we've all worked jobs. We've had orphaned IRAs or orphaned 401ks. People don't even realize they're out there orphaned. This is one of the best surprises you guys help people do, right?
Yeah. And I mean, this is like the laziest money out there. That's the easiest to get. So if you raise money for a fund, okay, let me try to make this point for you. There's $35 trillion in retirement accounts in the US. There's no more money anywhere, period. And the nice thing about it, it's all people that have it. It's like your friends and family. It's the people, the guy you're running with, or, the person you do yoga with. I don't know. They have an IRA or 401k. It's everywhere. And even if you have existing investors, I gave an example. I had a fund come to us who had never raised from IRAs. We just did one webinar to their investor base that had invested non-retirement account dollars, we opened over 350 accounts.
Whoa.
From that one group.
Wow.
Okay. That was a lot of money going to that. And they just like unlocked all this money that got invested into their fund.
Well, before we get into more questions, we got to drill in on that. So let me paint the picture. So a group that knows how to invest real estate, they've been doing it for a while. They're proven sponsors. Learn about your organization. You do a joint webinar where you teach. You're a teacher. That's why you're the author of that book, the Self-Directed IRA Handbook. But remind me, out of 350 to actually take action, how many do you think the email went out to in the webinar? How big was it? Is that like 50% or 80% of the people that were reached?
I think they have thousands of investors. I'd probably say 2,000 to 3,000. But they had a very high percentage of people, like very high, that took action.
Tremendously high. That's tremendously high.
Yeah. But these are people that have put money in on something with them, you know?
Yep.
So this wasn't a cold list. These are people that have already decided to invest with them with other dollars. But so many people think of their IRA or 401k and they're so frustrated by it. You know, frankly, most people don't even know what their IRA or 401k is invested in. It's in some target date fund or mutual fund. They don't even know, you know, and all of a sudden they're focused on investing in real estate and they're like, oh my gosh, I'm learning this, or I understand this better. Or, you know, I run into real estate clients all the time. They're like, I make so much money in real estate. I have this dumb stock portfolio in my IRA or 401k. So for certain people, it's an easy sell. It's a quick and easy sell because they don't know what they're invested in. And even when they are, a lot of them are just unsatisfied. Now, I will say there's been a sticking point lately because the stock market's been down, right?
Right.
So some people are like, well, I want the stock market to rebound a little bit. You know, it's like, okay, you know, I don't know.
Yeah, I want to talk about that for a second, but then I want to drive home another point that you're making that is so powerful. One, you know, I'll come back to the stock market in a second, but for those of us listening, this is one of the most popular shows for those of us who are professional syndicators. So perk up, listen up. This is so interesting. Matt, truly, you teach. So when you do these joint webinars with people that have communities of investors, like at us, for my team at Accountable Equity, we have hundreds and we have thousands that read our emails. So if we were to do a joint webinar, I imagine people would hear this for the first time. And you're saying during that discovery, these are people that actually already know, like, and trust the person who brought them to your education. And therefore it becomes a very smooth transition. I agree with that philosophy.
Yeah. And you just got to make it easy. So that's the next thing is you got to make it easy. But, you know, I think some of our competitors, you know, have gone to this like fintech route.
They have.
People are just going to click some buttons and they're going to do it. They don't. I'm just telling you, I open way more accounts than they do every day. We're going way faster than those, you know, the fintechy ones out there. People want to talk to someone. You know, it's like, oh, I'm going to send over $100,000. Yeah, I'm not going to click some buttons on a company's website I've never heard before. I'm going to talk to somebody, you know? And so now we got e-sign and stuff that's easy, but you got to make it easy, but also be available to answer their questions and know, you know, if anybody that's raised capital knows this, there's an education and a conversation and some trust building that needs to happen in that process. And so, you know, we play a small role in that with the retirement account, just how that works. And let's take care of the paperwork and get the rollover transfer done. But then it's, you know, they're already interested in the fund and they have an investment. That's the best account for us, right? They come over here, they're ready to go. The money pops in, it goes right into the investment.
Yep. That makes a lot of sense because the money hits your trust, the trust that your team manages, makes it compliant with the IRS and the government. And then it goes back out because they already know where they want to place it. They just need to get it into your vehicle.
Exactly.
And last little goofy thing. And Matt, am I the only person when I first heard about this 5 years ago that thought that when someone says use your IRA money to invest, that's what I probably heard the first time. I was under the impression that people wanted me to pull it out, take penalties and put it out. That is clearly not what we're talking about. Am I the only one that ever gets confused about that?
Yes, people do get confused about that. In fact, I just was like talking to my neighbor next door, telling them what I do. And that was the confusion. So what's the penalty to do that?
The penalty.
No penalty. Yeah, no penalty. Well, do I have to be 59 and a half? No. I'm just saying, like, you still have an IRA account. It's just not a broker dealer buying broker dealer products. Like that same IRA money, whether it's a Roth IRA, traditional IRA, you could also have solo 401ks for those self-employed. I mean, we self-direct HSAs and covered education accounts. All these types of like tax preferred accounts that the government's allowed can all invest in real estate and private funds. So the only thing we're changing is the investment asset type. So no distribution, no tax, no penalty. So if you're going from, let's say, Fidelity to directed IRA, it's kind of like you just went from Fidelity to Charles Schwab.
Right.
You've just changed the company that's administering the account. It's still the traditional IRA or Roth IRA or whatever it was when it was at the broker dealer.
Yep. I think we've done a lot already in this brief podcast to help people see that we didn't even know we were confused. Like 5 years ago, I didn't realize I was confused about IRAs. Then I've learned it. Now I get to hear from you. And for those of you, that was 101 class. We're about to jump into 201. Okay. But before we jump into 201, let's take a moment to listen to a wise lawyer. And you are also a CPA as well, right, Matt?
No, just a lawyer. My partner Mark's a CPA. Yeah,
That's
just a tax lawyer.
All right. So you're just a tax lawyer. Now let's talk about what you see on the horizon. Let's take a break from directed IRAs for a moment.
Yeah.
What is on the horizon? You read every morning about the topics. You're in it. You see billion dollars move.
I invest in real estate myself. In fact, I invest in real estate with my retirement account. So right now, there's going to be some real estate opportunity, right? I went through 2008, and many of you listening probably did. I think a lot of people are out there going to see rates are going to stay high. There's going to be some corrections. There's going to be some distressed property. Guys, that's opportunity. And what it's going to take to seize on that opportunity is money. Now, I'm already hearing the banks are already starting to tighten up, changing lending standards. They're getting scared too. So where's the money? Well, they're in IRAs and 401ks, the 35 trillion out there. And so for our business and for what I do, it's super exciting because I saw in 2008, the self-directed IRA industry, that's really when it kind of took off because this capital out there became very popular. Yeah, our industry grew so quickly at that point. And it's because of all the opportunity in real estate and alternative assets, and it took money to do deals and there was lots of profits and money to be made. It was a great time. So I see that coming up a little bit. I don't know if it'll go as deep as we did in 2008, but if you're waiting for the deals, it's going to take money to pull these off. And people are starting to kind of, I think, change their budgets a little bit, how much money they might be willing to throw out there. It could be tightening up a little bit too, just individual investors. But if you have this focus on this other pot of money, that's the largest set place where cash can be raised, IRAs and 401ks, I think you set yourself up for a lot of opportunity.
Right. And I think embedded in that, without a doubt, that's another epiphany. People have to, it takes your breath away to hear the number 35 trillion of us hardworking families are sitting on IRA money. Compare that to other areas of capital in this world. Is that bigger than most other aggregations of capital?
There's nothing bigger. Not even close.
That's amazing. And it's mostly American IRA accounts.
That's just US retirement accounts.
Okay.
That includes 401ks. So IRAs are about 40% of that. 401ks are another 40%. IRAs are actually the largest now. There are more money in IRAs than 401ks. And then you got kind of the defined benefit and pension plans too, which are still out there, but those are a much smaller portion of the market now.
I'll tell you, it'll be fun. Maybe we do a masterclass together sometime on a webinar because there are deeper questions. This is just a cursory level. Yeah. And, and I'll just put an exclamation point. You believe opportunity in real estate is coming. And you pinned most of your interpretation on that around the idea that rates are going to remain high. And would you go the next step and tell our listeners who don't quite see that they don't see it as big a deal yet? Because what happens when rates stay high for a period of time? I would say it goes back to the underwriting from 2 years ago, right? The projects will not get refinanced.
Right. The banks are going to be tight. People with adjustable mortgages are going to get adjusted and it's going to put pressure, and really it kills the operating profits for people owning, I don't care what you're raising money for, commercial, multifamily, whatever it is. Someone owns that asset and is going to be paying a lot more to the bank to own it now. And so I think it's going to put a lot of pressure in the market, and that's going to create people who are going to need to sell. And we've been in a market where people didn't need to sell, right? Money was so cheap. We had these record low interest rates that no one's seen in our lifetime. And so obviously the market had a huge run up. So I think things just in Phoenix where I'm at, I've seen the market shifting. I'm seeing contractors not as busy as they were. You're seeing all these little signs and signals, properties that will stay on the market longer. All those little stats you can track, you're starting to see movement. And for some people that already own real estate, and it's like, and you can be in that position. I realize there's a lot of people you might already have a fund and you own a property in a building and you're looking at rates that might be adjusting on your building, and it could be changed by 4%. This could be a lot of money. This is like a property significantly cash flowing to being in the red.
Right.
Some of these swings that are going to happen. And so I even had one of my law firm clients, we actually used to do private placements. I have another attorney in my firm that does those. And it was talking about raising more money just to kind of shore up and make sure he's got cash available for rates and financing that's going to start adjusting.
Man, thank you for teasing that. Can you, these are syndicators who listen to this show from all levels, meaning done one deal, done 50 deals. It's a true resource for all of us professionals out there. So tell us what that means when you say people are raising money to keep in cash or putting it in their fund for these changes. Do you see that happening more in this changing economy?
It's kind of newer right now.
Yeah.
I mean, we would see it for like, I'm doing a renovation on something, or we have some idea we didn't initially think about, or something went over cost. We see that. But in terms of like, rates are adjusting, but the communication has to go out to the investors, because what else do you say?
Right.
I mean, you're telling your investors on what's going on, and all of a sudden like, my quarterly check is not so big. What's going on?
Right.
And so don't think like I'm like the smart fund sponsors get ahead of it. They go out and they try to figure it out and get ahead of it. So because the last thing your investors want to see is you in a position, where the fund's losing money and they're not getting any checks. So I would just say, just look at where you're at.
Yeah.
Obviously, financing is going to be tough. Rates, I think, are going to stay high at least for a couple of years. They're not going to drop within the next 2 years, right? The Fed's been like hell-bent on that. And everybody that invests in treasuries and where rates are going, just because we follow that quite a bit in our business, is nothing's dropping for 2 years. And where rates are at now is, I don't know. I just see cash now becomes much more popular. Like a couple of years ago, debt was so easy. Just go get more debt. It's so cheap. Just go get more debt. Don't dilute yourself in equity and raise more money. Now that's going to shift. Go get the money. Go get the equity. The debt's more expensive.
I think you're saying wisdom to those of us who are newer in syndicating groups. You have to really keep your eyes wide open. It will change the IRR. It'll be more modest on the deal you had, whoever you are, but it'll also be more secure. So there's a trade-off there, and people will appreciate your story.
And there could be new deals that could have higher IRR.
Because your basis is lower.
Yes, because you're going to find some opportunity,
Yep. Basis being lower. So now we're going to go into some 201 questions before I let you run. I know how busy you are running that big company and your practice. So here's a couple quick questions. When people think of a self-directed IRA, many of the stories that people have these epiphanies, they move their money into their self-directed IRA, and a lot of times they'll try to do private lending with it. So now they have $200,000 cash, and they knew this flipper and he needed $100,000, and they loan him $100,000. That's a viable option. That happens a lot, correct? In the world of directed IRA?
Oh yeah. Very common. In fact, just at this desk here where I'm sitting right now, I did a webinar with one of my clients for many years. He's done 250 flips in Phoenix market in the last, 7 or 8 years. And 60% of them were funded by IRAs.
Wow.
60% of those deals, because he knows the strategy. It's just way easier, and it could be a win-win, whether you're someone that's flipping the properties like this guy, or one of the accounts that's lending the money out and getting 10% and 2 points. Love to get that type of return in this market. So it can be a win-win. And that's a very, very common strategy.
It is. And I'm seeing more now, and I think it's going to grow in popularity for those, let's say this gentleman you just spoke about, or this, once they get to that scale, a lot of times they do explore directed self-debt funds or debt vehicles, because it allows them to not have to go back each quarter or each 2 quarters to go back and get new capital, but it still provides strong yield with collateral. I see that growing in the next few years. What is your opinion?
Absolutely. And one of the most popular types of vehicles are these private debt funds, out there. If you go, or like financial advisors putting their clients into private equity funds that are private debt funds. I mean, those have been some of the, they've been tracked, some of the best performing assets recently. But even on the smaller scale, just people individually doing it, cutting deals with their IRA or retirement account dollars, lending to someone else, or in smaller funds that advisors aren't out representing and raising capital for.
That's right.
We've seen very, very popular. But you got to obviously have a strategy, right? And you got to have the deal flow too, because you got to put the money to work.
Correct.
And so that's one thing as a fund sponsor, you got to be careful on how much you're raising, so you have the right deal flow to get those dollars out. And
Well said. Next 201 question. I hope you're sitting down, folks. Now let's get into a question you hear a lot. And if you could just teach us a little bit. What's the difference between what a lot of us do in the 506C, the Reg D regulation where we're allowed to raise capital, especially the Class C, which is 506C, where we can talk about it publicly. Yeah. What's the difference between that type of model and a REIT for the investor point of view? And what is a REIT?
Good question. Yeah. I wish more people did REITs, actually.
Wow.
I'll give you a little nuanced reason why, but a REIT is just a tax classification, real estate investment trust. But it could be your LLC or LP that you have that was a 506C Reg D deal. You just get it tax classified as a REIT. Now, in order to do that, I think you have to have like 100 plus investors. Okay. So for some smaller funds, it may not work. But if you have 100 investors, I actually think it's worth doing. You have to distribute like 90% of the cash flow, and you can't sit on capital, so you got to be distributing. But I think most private funds that are like buying multifamily, for example, are doing that anyways. Or even commercial stuff, they're just doing that anyways. That's part of the fund model. So there's one benefit to the REIT. So in a LLC limited partnership, when you raise debt, let's say I get some IRAs that invest in my fund with me, and then I go buy an apartment building and I go leverage that apartment building 60% with debt. Well, the IRAs have to pay this tax on profits from the debt called UDFI, unrelated debt financed income tax. And sometimes it's part of UBIT or UBTI if you hear these little monikers. And you should kind of know this if you're raising capital with IRAs and 401ks. I got a whole chapter in my book on it. I got webinars and other content on it. But it's usually with depreciation, other expenses, it can get offset. The IRAs don't need to worry about it till you sell the property if you still have debt on it and there's a large gain coming through. They get capital gains rate. It's not too significant, but it is a little tax that can hit an IRA. REITs are exempt from that. IRAs get an exemption on it if the fund was taxed as a REIT. It makes absolutely no sense because the REIT doesn't pay any more tax. It's just, the stupid tax code. So that's a little benefit. And some of my clients that have raised more with IRAs, I'm like, you really just need to do a freaking REIT. Just please make it easier on your people.
So I've always heard that you can avoid. So then you could put the debt on the building, have it in a REIT model, and not have the debt cause the unrelated debt income. Is that what I think it is?
Debt financed income, yeah.
Financed income.
Unrelated debt financed
And to back up for those, I'll explain in layman's term. It's just saying that we bought a $1 million or $100 million project, but we only had to pay equity of 30 million. That means 70 million was debt. And the debt, when it was sold, we picked up the gain on the full 100 million. Therefore, it was as if 70% was unrelated debt finance income. So somehow that creates a capital gain just on that portion, correct?
Just on the debt piece. And you get capital gains rate of 20%. So when you run the numbers, if it's but it is just something they got to know because it does.
And it's not until liquidation, you just said.
Well, it could apply year to year if the cash flow, like if the K1 they get, has net profit on it. But if the K1 has depreciation or they're all the expenses, even though if it's cash flowing, the K1 is a negative, then there's nothing to report. But if there's positive cash flow, or I shouldn't say positive cash flow, if there's profit on the K1, yes, they would have it year to year.
But it would be capital gains rate?
On rental income, it's not. They will pay it on rental income rates, which is ordinary rates.
And it would be all fractional because it would be based. Wow, that sounds hairy. It sounds a little hairy. Now, you also do something called solo 401ks, correct?
Yep. Solo 401ks.
Now, somehow that is a way to prevent that problem for syndications, correct?
Correct. Yeah. So if you have a solo 401k or any 401k really, or employer-based plan, that can invest in real estate with any debt, and you're exempt from this also. So that's why I said UDFI really applies to IRAs that are debt leveraged. But I'd say the majority of our real estate clients still go get debt with their IRAs and they just deal with it. You know? And there's some other strategies to get out of it we couldn't get into here now, but it's just something someone should know. And I just brought that up particularly because you asked the REIT question is if you're raising a lot from IRAs and you have 100 plus investors, you should use to seriously look at doing a REIT. You'd actually be very attractive to an IRA investor.
It would. And now we're going to dig in a little more on the REIT. So as a layman, I see a REIT as something where the investor is seeking a double-digit yield, perhaps, or a strong yield, but not recapitalization, right? So whereas a syndication, typically you're trying to buy it, flip it, and put the capital back. Whereas a REIT says, keep the capital invested, keep the checks coming. So that's a big shift for most investors' mindset and most syndicators' mindset.
Yeah, but you could still be a syndicator. You got a value add type property that's a 5 to 7 year cycle to turn. You can still do a REIT on that. But you're right, the REIT has been used more for, this is an ongoing perpetual fund. So if you sell that property, everyone's staying in and you're just going to go buy the next one.
Correct.
Which is another way to think about it too, is just keep that as a rolling fund almost, and just go do the next property, build a big portfolio. You don't have to distribute. And you could distribute some out to some people that want to cash out and be gone, and the others stay in and move on to the next deal.
Yep. And the last thing on this REIT idea then, so if someone were to set up a fund, a normal syndication, I should say, and they get to 100 members, but they didn't think they were going to be a REIT, but they allow for it in their operating agreement, can they change to a REIT 5 years from now?
Yes, absolutely.
And what happens to the investor in that scenario?
I mean, it doesn't affect the investor. It really doesn't. The only thing, it adds a couple tax benefits to IRAs in this instance. So to the investor, nothing's changed. Like, I just start trying to think, like, who can get negatively affected? No one is negatively affected. I mean, it puts some rules on the sponsor because they got to meet the criteria, but they also have to make sure they're doing distributions. They're distributing, I believe it's 90%. I can't remember, but
I believe so too. Very interesting. Matt, I feel like you've done a ton of value here today. If there's something I forgot to ask you, please share it, but also share how we can reach back out to you and learn more.
Yeah, best place is just go to directedira.com. That's our website. We have a learn section. We have a podcast, Directed IRA podcast. We have webinars. I'm trying to get Josh on one of those. But a lot of educational content, events. There's my book. My book's $20, but it is kind of like, if you want to geek out on this, you're like the engineer or the CPA or the person that really wants the detail. My book's there too. But we got the easy, lighter stuff too, the podcasts and webinars too.
And you guys are great at it. You guys do it together, you and Mark.
Yeah, right? Me and Mark, we have two. So we've got the Main Street Business Podcast, which has over 2 million downloads now. We've done that for years. That's on tax, business, and legal. And then the Directed IRA podcast, which is just focused on the self-directing topic. You
guys do great work. You're hilarious together and educational. Really appreciate you, buddy. Can't wait to talk to you again. And thank you for being part of this community.
All right. Of course. My pleasure. Thanks, Josh.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.